Hello and welcome to this week's edition of Invest Africa. I'm Alicia Seckham. According to the African Development Bank's annual African Economic Outlook, FDI to Africa is set to rise by more than 10% in 2013, approaching its 2008 record high, with the fast-growing sub-Saharan region likely to receive the majority of inflows. FDI is forecast to reach $56.6 billion this year, and that's from $49.7 billion last year. And where Africa's growth momentum has been supported by increasing FDI from across the globe, the contribution China is making to that investment flow draws attention. According to Standard Bank, China's total FDI into Africa accounts for just 3% of Africa's total FDI. So why is that sitting so low, and how do we up it? Joining me to share their perspectives is Greg Knott, Director of Africa Practice at Werksmans Attorneys, and in our Cape Town studios we have Glen, who's a partner at KPMG. Gentlemen, welcome to the show. Thanks so much for joining us.
Alicia.
Let's start with a closer look at the kind of Chinese flow we're seeing right now, Greg, because Chinese investment into Africa has been welcomed in some quarters. It's been viewed with a bit of skepticism in other quarters, and it's also been critically looked at in terms of how we leverage off the opportunity that does come to the fore. What kind of investment flow are we looking at here?
Well, Alicia, the Chinese story in Africa is a great story, I think, and no doubt many in the public commentators think exactly the same. It's one which is just growing exponentially, and the red flag on the continent isn't a flag to say stop, it's a flag to actually say go. I was very happily in Beijing just recently, just after the president's election, and there was great talk on Africa in the press on that particular week. You know, we always tend to think, well, are we drumming up our own publicity? Do we believe our own story? But that story itself was there loud and clear in Beijing after the president's election. What are we looking at in terms of investment? We've seen resources and commodities over the last decade or so being central to investment. But more and more do we see the services are in and around resources. So we'll see the financial services, manufacturing, and so on. And we see it in the space of energy in particular, certainly within South Africa. And we're also looking at port development. For instance, I'm looking now in Tanzania, infrastructure. And so I think the investment has just begun.
Yeah.
I'm not sure what Glen will say to that, but that's my own optimistic view of it.
Well, let's bring him into the conversation at this point. Glen, the way China needs to, or makes investments right now, needs to be highlighted, though, in that in most instances, we see a value chain being created that's primarily government-driven as opposed to private sector-driven. What's your sense of the overall investment model that we're looking at?
Alicia, I think we're seeing more and more of this private investment into Africa. There are smaller companies, obviously, compared to the large state-owned enterprises, but we're seeing some light manufacturing happening, manufacturing of shoes, textiles, tanneries in other parts of the continent. So we're seeing more and more of that because, like everyone else, they're seeing Africa as the next market, and they're really looking at being on the continent.
While that stride is being made, though, Glen, there seems to be vast discrepancies in terms of the kind of an amount of flow we're seeing from the government side of things as opposed to the private sector. So one's got a question to what extent this makes things a little bit tricky in terms of managing this relationship moving forward, because it will then speak to international and international relations, international policy, where, for example, South Africa's just joined that BRICS grouping.
That's correct, and I think there's been a lot of underreporting of the private investment because of the different reporting levels that they need to perform in China. I think it's under 10 million that they don't have to report, $10 million US, so they don't have all the figures as to the number of small enterprises that are setting up on the continent.
Mm-hmm. Looking at the kind of presence that we're seeing come through from Chinese investors at this stage, Greg, where you highlighted some of the sectors that seem to be on the radar screen. Do we need to get country specific as well?
Well, I think it would be interesting now to see where our regions, what regions are attracting Chinese investment, because that, Alicia, will be the strength of Africa and the way it trades and the way it does business with China. It's regional growth, regional powerhouses, which I think will give leverage to our own markets and also make huge sense in its trade with China. It'll give us quite frankly, a better negotiating leverage if we had to look at the regions. And I think that would be a very interesting synopsis to have a look at.
The
analysis.
perception out there is that China comes in, it extracts resources, it reaps the profits without plowing back in terms of investment. Is there some acknowledgement that needs to be made with regards of a relationship that's growing in a broader commitment to?
I think that's a very unkind take, and I think it's one that's been levied by the Western press and predominantly in Western media. I think there may have well been in the past that perception, and certainly it carries through today, but it's growing softer as China itself, driven by its leadership, and particularly the new president, he talks of a new rejuvenation of China, that it's new Chinese dream. And part of that Chinese dream hooks upon transparency, anti-corruption. It looks at the softer issues in and around business. And I think that will translate and extrapolate itself onto our continent. And certainly within the clients that we represent, and we've seen across the continent, where there's more of a consciousness on CSI, in other words, corporate social investment, and looking at just rather than going, as you say, plundering the assets or plundering the resources, there is far more an acute sense that business is greater and bigger. And to be fair to China, it has, over the decades, it has engaged Africa. It has on many levels. And we look at the Forum on Chinese and African Cooperation, it had 8 promises. And those 8 promises, to a large degree, have been carried out, and part of them were training, skilling up agricultural technologists, building schools, rural schools, and so on. So I think there's a great awareness that China leads the developing world and is part of the developing world, and as being part of that, has to grow this other part of its business other than seeking commodities.
The risk, of course, that comes with this type of approach, Glen, and that being private sector approach, is that the investment get made only if everything goes according to plan regarding global economic growth, if business can afford it as well, because it's the 2008-2009 recession that saw the development of these linkages taking a backseat in the first place. So just to throw a spanner in the works at this point, can business be solely relied on?
I think so, because for them they're looking for new markets. Costs are getting high in China, and so they're looking for markets where they can be closer to the market and where manufacturing costs can be lowered as well.
I guess that then throws the spotlight on something like beneficiation as well. It should play a role in mitigating against some of that risk to an extent, Glen. So moving away from China exporting raw only for African countries to import finished product either at a more expensive price tag or to the detriment of our local markets if that product comes in cheaper. What kind of stride are you seeing in us being able to balance the scales in that regard?
I think, as Greg also mentioned, it's about good governance and how do we actually as countries lay down the sort of investment rules for investors wherever they come from, you know?
Do you think, Greg, that we're becoming a lot bolder in terms of establishing our own rules of engagement?
Yes, I think we are, and I think that's right. I think the regulatory environment is changing hugely because I think countries, and we can't always just speak of Africa as Africa. We all know 54 countries and so on. We've got to look to each of the countries themselves in terms of what they have as regulations. But there's a sense, an acute sense of awareness that the stronger the regulatory regime, the better the ability to attract investment, the better to negotiate good terms for oneself, and so on, and so it goes. So I think there is an awareness that a good regulatory environment attracts so much more to it than one that isn't.
Yeah, we had the spotlight on beneficiation, Glen. In part, it's seen as a solution to solving some of the trade imbalances that we currently face. And, we've had what Robert Zelek certainly urging Chinese companies to expand beyond infrastructure and beyond resource-related projects as well, investing, for example, in the manufacturing space on the continent too. What challenges do you see us facing going down that road?
I think it's probably the infrastructure challenge is the biggest. Is there enough electricity? Is there enough other issues of infrastructure that are needed for beneficiation and in the manufacturing process?
Looking at how we can start to tackle these issues, practically speaking, Craig, I mean, what do we need to be addressing with extreme urgency right now?
In terms of beneficiation?
And getting the ball rolling a little more successfully in that regard.
It's always about education as well. What is needed? And I think that's both for the populace and within the countries, and certainly with your trading partner as well. The need, if that need is actually known, that there needs to be a skilled up in terms of labour force. There needs to be an understanding why it's important for a country to have beneficiation, as I say, labour, work and so on. That education is primary. It always roots down to education and informing one's trading partner, informing one's own populace why it's so important.
How's that cost imperative looking in your books?
Well, it will be a cost. Of course it will be a cost, but I think it will be a price that we haven't yet paid, certainly in South Africa, high enough. And I think that's one that we've got to factor in going forward. Education's got to come, quite frankly, almost at any cost.
I asked the question, Glen, because you highlighted a little earlier that labour costs are rising in China as well. Do you see the table starting to turn at all, where there might just be a cost imperative to producing finished product on the continent itself, because there's a pressure to start shifting to lower cost locations, but also doubt on whether China's low-end industries will actually shift to Africa?
The so-called sunset industries that are sort of the low end of manufacturing, and we've spoken previously about the 5-year plan where China wants to move up the value chain. So a lot of those industries are finding it's just too expensive to produce effectively in China, and also for them to be closer to markets, the current market of Europe and also the future market of Africa as well. So I think that's why we'll see a shift to Africa, but traditionally Chinese companies have invested more in the Asian space.
Well, China's government seems in no hurry to let go of its labor-intensive industries as a whole, and let them move over to African countries. We just have to point to the government's policy of restraining its currency appreciation, for example, against the dollar. So the challenge you see that posing, where protectionism of economies has become a global phenomenon?
All the more reason to shift your production, say, from China to Africa if there are barriers to your product. Then if you manufacture it locally, then obviously you get past those barriers easier.